What's up, you guys? Welcome back to Business Buzz, where we focus on business, entrepreneurship, and investing. Today, we're going to be talking about the best stocks to invest in as of May of 2020. The stock market this year has been quite the ride due to the virus, and there are a lot of stocks that are very undervalued. Today, we're going to be checking out 4 of them that I think are the best deals and have the most room for growth that can make you guys a lot of money. Also, all of these stocks just happen to have a dividend payout. When I was researching these companies, I actually didn't intend to just find dividend stocks, but all of them happen to pay out a dividend. So if you love dividend stocks, this video is going to be great for you. All I ask before we get started is to please go down and subscribe to our channel and make sure to turn on those post notifications. Number 1, Wells Fargo. The financial sector of the markets have taken a beating since the virus. They are down twice as much as the regular S&P 500. Wells Fargo might have got the worst end of the stick when it comes to banks, as it is down over 38% just in the last 3 months. As a company, they offer a plethora of different financial services, but they are most well known for being a bank. This company is definitely not short of any controversies. They have been caught up in a lot of bad things: underwriting, fake accounts, all sorts of scandals, regulatory scandals that are a little bit scary. However, their new CEO, Charles Scharf, their 3rd CEO in just 4 years, is fixated on getting the public's view back in a positive light for this company. Also, the CEO just bought $5 million worth of shares in the stock for around $28 a share, about what it's trading at right now. And that's always a good thing to see when you see insider executive trading. That's when you know the stock has a good room to grow, because their own CEO thinks it does. The last time their stock was trading for under $30 a share was around 8 to 9 years ago. Wells Fargo has a hefty dividend of over 7%, and the Fed has actually been giving banks breaks, so they will be able to continue to pay this dividend most likely. The net income has been at a steady decline since the second quarter of 2019, but we should see a turnaround in these banks pretty soon. Keep in mind, this is a long-term investment. Short-term, there could be some big hiccups, some big spikes, but long-term, I am very confident that there is a lot of money to be made. Number 2, Disney. We all know and love Disney, and that's just a testament to how strong their brand is. Their newest project, Disney Plus, is growing at an insane rate with over 50 million subscribers. Just a few months ago, their subscriber count was under 30 million. So the quarantine is actually a great thing for Disney Plus. All the kids are off of school, so their parents are getting their kids subscriptions. Anybody who likes Disney is getting subscriptions, and even once this is all passed through, people will be accustomed to being subscribed, and they will probably stay subscribed to Disney Plus. Despite the growth in Disney Plus, their stock has plunged from around $140 a few months ago to just trading above $100. This is due in part to the fact that a lot of parts of their business and their streams of revenue are out right now. Their cruises, their movies, you can't go to a movie theater right now. Their parks, a lot of it is down. Really, it's only Disney Plus that's doing well for them. Their forward PE is actually quite a bit higher than their current PE, but that is to be expected with, again, their cruises, their parks, all of that. So it might be a good idea to wait until their earning report comes out, wait for it to drop a little bit, and then buy. However, in my opinion, even a buy right now at its current price could make you a lot of money in the long run. And it's also important to mention that they do have a dividend yield of 1.7%, just as a little bonus. It's important to note that they have paid out dividends and grown their dividends for over 40 years now, so it's a pretty safe dividend to account for. Number 3, Starbucks. Starbucks is a coffee chain that sells high margin, very tasty drinks that consumers cannot seem to get enough of. Even during a recession when money is tight, people are too addicted to stop drinking these coffees. They might take a step back from making big, unnecessary purchases, but when it comes down to a small splurge on a nice coffee, they'll still buy it. Their stock is down around $10 from a high of $88 before the drop. Starbucks is also looking to outgrow their biggest Chinese competitor in Luckin Coffee, and Luckin Coffee just seems to constantly shoot themselves in the foot, so Starbucks should be able to take advantage of that. So often when we look at companies, you always think of American growth and stuff, but China is a big market. So if Starbucks is able to get a strong foothold in China and take over Luckin Coffee, that could be some big money coming in for Starbucks. A lot of people don't know just how large of a company Starbucks is. Their market cap exceeds Dunkin' Donuts, a main competitor of theirs, 18 times over. That is absolutely insane. Their revenues are also growing at a staggering rate. In 2009, they did around $9.8 billion. Last year, they did over $26 billion in revenue, and they continue to be growing. Their profit margin is also unheard of at 14%. That's pretty good in their industry, and their profit margin actually used to be a little bit higher at around 18%, and if they can get back up to there, pretty good. This is yet another dividend company with a 2.17% payout. Their payout ratio is 25%, which isn't great, but that also means that their dividend has room to grow in the years coming. Lastly, number 4, Sony. This company is an electronics company most well known for their gaming consoles such as the PS4. Everyone I know, especially around my age, is at home in quarantine right now playing video games, and that is only going to increase sales in their consoles, their VR systems, and all of their gaming products. They've actually been a very well performing stock in the last few years, but they are down around 12% in the last few months. Their PE ratio is under 13, which is pretty amazing for their industry. Their dividend payout, though, is just 0.61%, pretty lame because their payout ratio is less than 3%. Very stingy there, I will say. Their EPS has been steadily growing for the past few years. However, when their earnings come out on May 13th, analysts do predict a bit of a setback. So again, I would wait until after earnings come out, wait for their stock to possibly drop some more, and then buy up some cheap shares. Their new console, the PS5, is rumored to be coming out around the holiday season of this year. However, with the virus, I wouldn't be surprised to see that set back a little bit. The gaming industry also is currently valued at around $1 billion, with many experts expecting that to reach around $7 billion by the year 2025. There's even some experts who predict they could grow much larger, possibly a $100 billion to $300 billion industry within 5 years. Obviously, Sony will vastly benefit from this because they are largely a gaming console focused company, and the more that gaming grows, the more people are going to want some new consoles. Guys, that about wraps this video up for the best stocks to buy as of May of 2020. Really hope you took some value from this video. Hopefully you can make some money off of these picks. And make sure to go down and like this video, and I'll see you guys in the next Business Buzz video.